This episode of Good Investing Talks is supported by In Practise. In Practise offers a selection of interviews with high-quality businesses. They focus on doing deep interviews with executives, people around businesses, and people who have knowledge about certain industries. So if you want to know more about great businesses and their future and background, please click on the link below this video to get more information about In Practise. And now, enjoy my conversation with my guest. Hello, audience. Hello, Nick. It's great to have you back at Good Investing Talks. I can now say it's great to have you back because you've been here last year, and I think I will also show the video of last year above so people can have a look. It's great to have you back. You're in the morning in California.
Yeah, I'm worried, Tillman, because now, I'm going to wonder how much I've aged since we did the video last year. But it's good to be back.
I think you have more kids, as we see in the background. It's some nice kids pictures. That's great. Congratulations again. And
yeah,
as a family father.
3.5 and 1.5. So they definitely kind of keep me busy when Naked's not keeping me fully occupied.
But maybe let's move to Naked now before we get too deep into the family stories, which also should be interesting, but they are something for a glass of wine someday. Last year, we also talked about growth, and maybe let's start with this topic again this year, because many investors were interested in this topic. Maybe let's start with the basics. What is your capital allocation framework towards growth? Like, what kind of price are you willing to pay? How you're thinking about growth in terms of capital allocation to lay the foundation?
I think one of the hallmarks of Naked and one of the things that we pride ourselves on has been taking a real first principles approach to how we allocate capital. And that very much comes for when we think about allocating capital to growth investment. So a reminder for those who are new to Naked, when we talk about investing in growth, we're talking about the combination of money that we deploy through media, advertising in different channels, and in some of our markets, provision of a subsidy, effectively a loss-making first order to encourage members to try our wines. And in total, that's what we think of as our growth marketing budget. And the framework we use to make those decisions really comes back to thinking about the IRR, or the real rate of return we're generating out of investing in a set of cohorts. And, that's something that hasn't changed over the years. We can talk maybe a little bit about some of the complexities of working through that in, the course of the last 12, 18 months, which have definitely been, there's been more volatility in lots of ways than there has been normally. But from our point of view, we start from saying every investment we make should be generating and, adding to the intrinsic value of the company. And that means when we're investing to acquire a customer, we've got to be really confident based on the information we have, our 13 years worth of data, which contributes to a set of machine learning driven models that value our customers, that the stream of cash flows they're going to generate over the course of 5 years is going to mean we're going to generate an attractive rate of return. And attractive for this purpose means, you're making a rate of return substantially in excess of your cost of capital, even after you allocate everything in, including your overhead. So that's the first principles bit, and we can talk more about some of the nuance. But that hasn't really changed. I don't really see that changing because you can have a lot of change in sentiment, change in fashion, in terms of what people want to invest in. I think the best protection against that is to be really convinced that what you're doing is building something of real intrinsic value.
You mentioned the complexities, and I think my questions are a bit above a complexity bingo. So you're British, you might like a form of bingo. So if I don't hit all the words, you can add some after I finish the questions. But let's move on to try to see if I have the complexity bingo right. If you talk about growth, one of the basics also for you is labor. So maybe again a fundamental question, like if you say you grow 100%. As you did close to it last year, what does it mean in the staff you need, the additional staff? Is there a ratio like 100% growth means 20% more staff or something like this?
Really, we think about the business in terms of kind of two types of labor or two types of roles, right? You have some roles where volume is a factor, and you have some roles where volume is not a factor, if you just want to really simplify. So actually, sending a set of marketing communications or a trading plan to 10,000 customers, 100,000 customers, or 500,000 customers, actually you've got the same amount of work. It's not volume driven. Whereas if you think about, say, some of our operational requirements, actually, you will, as you go from 1,000 cases to 10,000 cases to 500,000 cases, you do need additional labor. So then some parts of our business, the volume driver is going to be a little bit different. So if you think about our American business, where we have a large planning and wine production group, there the really unit driver is the number of SKUs in the range, and the number of unique different bottlings we're producing is driving the work. So that's how we start to kind of form our planning assumptions and understand, well, how is the cost base going to scale as you grow? Overall, that means that we have an opportunity when we grow faster to see efficiency and leverage. And you saw that in a reduction in our SG&A base as a percentage of sales in the year FY21 as we grew the business really quickly. I think then the second thing, you come back to saying there's also a choice between overhead you have to add because you require more people to service a larger business, and discretionary investments, choices you're making. And one of the areas we have been investing more in over the course of the last 18 months is our product and technology teams. And really the reason there is we see the likelihood of generating value from that investment, a real return on that investment. Actually, all things being equal, increases as you scale the business. Because the amount of benefit you need to get from improvement on a customer level in terms of performance, from, say, developing a new feature, adding more functionality to your website, adding a new type of subscription, just improving the UX, whatever it might be, actually that becomes lower. You need a smaller improvement per member to generate, an absolute return on investing in additional capability and additional people. So it's worth separating those two things out. So I'd say all things being equal, you don't need to scale that many parts of the business that aggressively just because of the volume. But as the business has grown, we've seen opportunity to double down and invest back in improving parts of the customer experience.
So if you think about labor, we also have to look at the labor supply, especially in the US, that might be quite tight. Where is it the hardest to find people? You already mapped out the kind of labor you're looking for. Where is it the hardest in this kind of categories to find people?
I think we're getting close to the first buzzword, aren't we? We're going to do inflation soon.
It's on the list. It's bingo.
I thought so. I think we've been in a privileged position. Finding labor has not been that difficult. Ultimately, I think a lot of people want to come and work for a mission-driven company in the wine industry that's changing the way wine is made and the way it reaches people who are passionate about drinking it. So, ultimately, I think that gives us a strong source of competitive advantage. We've got an inspiring mission and we've got a great culture. But it's certainly true that there have been places where we've seen, the market rate for labor change materially. And that does feed through, like any business, into our cost base and our economics. I think the areas probably that have been most apparent have been the parts of the business where you've got a most commoditized labor pool. So if you think about primarily our physical operations, so warehousing, distribution, logistics, we've seen pretty substantial labor rate inflation there. And, we've also been making sure that, we're fairly moving reward for our teams on the front line who are talking to our customers every day. We call them our customer happiness teams because that's their job, to keep customers happy. But that's another area where we've made sure we've moved wages to reflect, changes in the overall labor market.
Growth also needs more wine. So how do you think about the wine availability, and also we don't want to get too deep into the winemaker side, but also the option to become a better partner for winemakers in this journey. And maybe you also have a rough share in which kind of percentages you are the partner for the winemakers. Are you from 10 to 100% in some of the winemaker categories, the main partner, or how much is your share there? Hey, Tillman here. I'm sure you're curious about the answer to this question, but this answer is exclusive to the members of my community, Good Investing Plus. Good Investing Plus is a place where we help each other to get better as investors day by day. If you are an ambitious, long-term oriented investor that likes to share, please apply for Good Investing Plus. Just go to good, minus investing.net/plus. You can also find this link in the show notes. I'm waiting for your application. And without further ado, let's go back to the conversation. One of the services or partner offers you make for winemakers is also marketing, to be a great marketing channel for them, to address wine lovers. You call them angels. But for this, you also have to be a great marketer to yourself as a platform. And maybe if you think about the whole space of food e-commerce and think of other players in the space, if you would give yourself like a Naked Wines the grade compared to the others, what kind of grade would you give yourself in the marketing capabilities?
Yeah, I think historically marketing has always been a core competence of the business, right? And, marketing, in my word, is sometimes a fancy word for the human thing of storytelling. And that was an insight very early on from our founder, Rowan, that, lots of people can produce great wine. Naked's got a model that means we can do that more efficiently, and we can allow talented people to create their own brands that they're personally invested in, which is differentiated. And we can bring that wine to market direct to consumer, so more efficiently again. But other people may be able to do that at points in time. So building that personal connection between wine drinker and winemaker has always been at the heart of everything we do. And that comes down to telling stories, right? Because if you talk about flavor compounds and phenolics and tannin profiles, there's a very limited number of people for whom that's interesting. If you talk about people, what do they dream about? What are they passionate about? What are they excited by? Those stories about people tend to be universal. So it's always been a core competence in the heart of the business. I think one of the things we have worked more consciously on in the course of the last year or two has been thinking about how we market ourselves to an audience of winemakers. And I think, really started, we ran a big effort, when COVID first happened, to reach out to winemakers outside of the Naked family and offer support. We put up $5 million and worked with over 90 different winemakers around the world. Sorry, I've got that number wrong, over 45 winemakers around the world. And, that was a great way to get the message about Naked out. And we've also, in the course of the last year, spent a lot more time and energy entering the wines we produce into big international competitions. So things like the Decanter World Wine Awards, IWSC, to showcase the quality of wines we're making. And I think we've realized that it's important to show to the industry the kind of quality of product you can make with Naked as a partner. And I think that's been really important in driving a little bit of reappraisal. And people saying, wow, okay, I knew that Naked was a fast-growing company. It was doing something different online. I didn't realize it was a platform that I could go and make world-class wine and win, gold medals at top awards and things like that. And I looked at one of the winemakers we just brought on who is going to be working exclusively for Naked in the US. It's a guy called Rudy von Strasser, and an amazing character, the founding father of an AVA in Napa called Diamond Mountain. And he's bringing his brand across, which has won, all sorts of accolades over the course of the years, and is going to be exclusively making and distributing that at Naked. And I think that's the type of conversation and opportunity that we wouldn't have had access to a couple of years ago. And the result is actually, we've changed some minds and done some good marketing of ourselves in the industry.
That's a great achievement. Congrats to that. But let's also look again on the customer-facing side. You are also offering the winemakers access to. Like, where do you want to get better in terms of like your internet platform, a tech platform in this way, in marketing? You think about performance marketing, different forms in the online world work a bit differently. And what are your projects to improve on this side over time?
I think one of the things we're always looking at, right, is where can we invest to get the maximum return? If you come back to that framework at the beginning, right, Naked's a fantastic business, and I love all the fun parts of the wine industry. That's where the passion and the energy of our teams come from. But if you wanted to be unromantic about it, you could think about it purely as a financial machine. You're putting down capital up front to acquire something, a customer or a cohort of customers, in the expectation of a stream of cash flows coming from those cohorts. And we spend a lot of time looking at, okay, what's the performance of that machine? What's the efficiency? Or to put it the other way around, where are the inefficiencies? And some of that leads to some of the things that we're really focused on at the moment. I think there are two areas that really jump out. And, this came from us taking a step back and looking at the overall shape of the business, having just doubled it. It was a good time to reappraise, where do we deploy resource and where do we not deploy resource? And two things stood out. The first one was that we were spending a lot more money acquiring traffic. So growth marketing teams looking to develop partnerships or, working with digital platforms or affiliate networks, whatever it might be, different ways of acquiring traffic, than we were spending money on improving the process by which we converted that traffic. And we think we've probably had the balance of that not quite right. So one of the areas we're investing at the moment is building the size of our conversion rate optimization team and giving us the capability to bring through more iteration, more testing there. In particular, looking at further changing the experience for different types of traffic and different types of customer, leveraging our personalization capabilities more for new customers, and frankly, just making the shopping experience easier and slicker. One of the things on the roadmap is integrating, for example, things like Apple Pay, more payment devices types for mobile devices. So that's one area that jumps out. The second area is then thinking about, if you think again about the financial disclosures we make, we have a very satisfied customer base. We've built the world's largest direct-to-consumer wine business, nearly just shy of 1 million members globally. And it's a very high retention business, right? Typically we see retention of revenue from that base at around 83% year over year. However, there is opportunity for us in the gap between the first order and then getting customers into that regular stream of purchasing. So that conversion from first case to second case. And again, when we stepped back, we said, actually, we don't have meaningful dedicated resource to that challenge. It's a part of lots of people's job, but it's not the only thing that many people wake up in the morning obsessing about. And again, when you thought about Naked dispassionately, this machine of kind of turning an upfront investment into a stream of cash flows, this is an area where a lot of stuff is falling off our production line, and I think we can improve it. So to do that, two things. One, creating a clear group of people within the business with dedicated responsibility and accountability for that early part of the life cycle. I think that's really important because if you think about the customer challenges, they're meaningfully different in the first few months than they become later on in your life. Because you've arrived, you've tried some great wine, but all of a sudden now you've got hundreds of products from winemakers you've never heard of, brands you don't know, and that can be quite intimidating. You've gone from a first purchase where we've made things very simple and curated, a selection of wines for you to try, to actually a much broader shopping experience. And we think we can do more to quickly help you understand the benefits and features of Naked, but also more through our products and UX to assist you navigate through that second shop and work out what you should be buying and why. So that's a big area of focus for us and an area that we think we can improve pretty materially.
As you were describing this, the picture of a house came into my head. Like, you already have now 2 floors or 3 floors, and the plan is to make it a high rise, but you need some underground digging to stabilize everything and allow the growth stronger. Are there any other topics you do underground digging that might be interesting to understand to allow you to grow stronger and faster and more stable in the future?
Well, you're being very good and you're holding out on your inflation, but I think the other area of focus for us, and actually, Tillman, an area that I've reflected, I don't think we've communicated as well as we could as a business, is around making sure that we have, our contribution economics are set up, exactly right in each of our 3 markets, the UK, the USA, and Australia. To allow us to grow the business at an appropriate rate with really good, consistent rates of return. So I think, in the time I've been at Naked, we've operated in, let's be honest, a fairly benign environment up until, the course of the last 12 months or so. And, that's meant that we have been able to drive, substantial contribution margin leverage, if you look at a group level, and that was in our disclosure at the half year. through two things. One, some like-for-like improvement within market as we leverage more volume to drive down the cost of production for our winemaking partners, and we're able to take some of that benefit for ourselves, share some of it with customers and winemakers. And two, we've seen at a group level, as the US has grown to be the largest part of our business, that's got a favorable mix benefit for the group's overall contribution margin. And I'm talking to our repeat contribution margin, the rate at which we translate sales to our members into that stream of cash flows that pays back on the investments we've made. I think the third big project for us this year is to make sure that we are ensuring that those margins are fit for the future. So I guess I don't know where we're going to take this analogy, but we're making sure we've got all the waterproofing and kind of damp proofing right on the house so that it's going to last a long time. And that's something that I think is really important. I think it's an area that we believe is very much within our control. But I don't know if we've done as good a job as articulating why we believe that as we could. So maybe it's interesting to talk a little bit more about that now. The kind of things we're going to be looking at to offset the inflation we're seeing, both in terms of the cost effective of getting a case to a customer, through our supply chain, and some of the inflation in raw materials, in particular things like glass, and then international freight transport are probably the two areas where there's the biggest pressure in terms of the cost of production. We're going to be looking at making sure, through our pricing approach, through the way we look at, recouping, some of the cost of shipping in some of our markets, that we are, continuing to offer great value to customers, but we're just making sure that, the balance of how we share that surplus that our model creates between customer and margin, is right and appropriate for the long term. And I think that means we've got an opportunity to, not just rebuild margin that we've seen erode over the course of the last 6 to 12 months, but actually we've got an opportunity to grow that over the course of the next 2 to 3 years. And it's one of the things, we'll be laying out in more detail when we get through and do our next set of results. But it's an area that I think is really important, and probably one that we just haven't communicated as explicitly about, because the environment's been very different over the course of the last 5 years. And I think that's maybe some people have taken that as saying, okay, well, do I have to accept margin erosion in the business if I want to have growth? I don't think that's true at all. You can look to our Australian division where, actually even in the course of the last year, we've materially improved margins. But that's a part of the story that I think we need to do a better job of articulating.
So maybe a more basic question, if you already switched to the topic of inflation, you have some industries. I talked to producers in steel. We also saw this in high gas prices in the last weeks, that the producers took more margin as a used opportunity if the prices are high and the raw material goes down. Is it also a chance for you, if there's a general inflationary setup, to give a certain structural price increases further and to contribute margins through it, because there's more acceptance to price increases in an inflationary setup?
Well, I think there are a couple of things. Firstly, it is a benefit of Naked's business model that we make exclusive product. So in any environment, when you're talking about price, that's useful, right? If you're, I learned in my early days as a consultant working with a ton of businesses, when you're in a world where you're selling the same product as a bunch of other people, then your pricing strategy becomes less within your own control. So, that's a benefit that Naked has. I think in terms of an overall philosophy, I think about it just subtly differently, which is actually because we've got an efficient model that helps winemakers make high quality wine at lower cost and strips out a bunch of steps along the way of getting that wine to the consumer that don't add value around distribution and retail, and reduces the number of margins from 3 to 1. That means we've got an opportunity in an inflationary environment to both, recoup costs and maybe even take some additional margin, whilst at the same time, if anything, increasing the amount of additional value or surplus we provide to consumers, because our model is actually well set up to deal with that type of inflationary pressure. And it's why whenever we're approaching pricing decisions, we don't just look at our costs. We don't just look at what's happening to input costs and the cost of getting a case to customers, but we also look at the data we're getting back from our consumers in terms of repurchase rate, We look at the benchmarking studies we do in all our markets to look at the relative performance of our products against comparable products in the market, to make sure that, whilst we're getting the margin structure we want, we're also guaranteeing our members the value and the superior value to similar quality wines elsewhere that they'd expect. So I think about it a little bit differently, but I do think that there is opportunity in this type of phase of the market for Naked. And I think we can do that in a way that's consistent with our values and carries on delivering great results for both customer and winemaker.
Maybe you can also try to describe inflation as a change and also reshuffling of markets, because there are different price dynamics and things come into play in a different way. Is this like a share to take market share in this market if you do the studies that you see that Naked takes market share because of the inflationary pressure?
We've been taking market share pretty consistently in our markets for a number of years now, but I definitely agree with the point, right? You see a lot of times where slightly tougher consumer environments, cause people to reappraise their purchasing decisions, right? I filled up my Mini the other day, and it was a $70 tank of gas. And I remember when I first came to the US, I think I could fill that up for $25, $30. So, that's a real impact that people are feeling and seeing day to day. And, I think my experience has always been that feeds through into people reevaluating their purchase decisions. And especially in wine in general as a category, it tends to be that people maintain volume of consumption and then look at the brands that they're picking or the retailers they're picking. So, to my mind, I think that is an exciting time for a business when you've got a model like we have, which is able to produce quality at a lower cost. That's a great chance to get people to try something new and understand when they try that, actually, they're amazed at what they can get. So we'll definitely be carrying on looking for opportunities to invest, looking for opportunities to amplify that message, because I definitely think, it's a time when people are likely to be receptive.
You don't have to finger point at competitors, but in your studies, who is in relation losing market share in such an environment, or like which models get less attractive compared to yours?
Well, I think the long-term trend that we're seeing very consistently, and the US has probably been slowest to move in this, but is a movement away from traditional purchasing, kind of either in independent liquor, chain liquor, or grocery, physical grocery, and moving into a number of different online models. The comparison 2022, late 21, 22 on 2021 is a little difficult, right? Because you've got businesses that went up very steeply, and some of them have struggled to comp that a little bit. But I think if you zoom out, that's the main trend. And I think, in particular, you look at some of the, there's just a big value advantage in the direct consumer model versus that traditional 3-tier system. And, that I think is going to be the long-term trend. And I think that's an area that's going to be, see the greatest kind of pressure or the greatest impetus, I guess, for customers to reconsider their behavior. Because there's a lot of people who are buying wine that way. It's just because they've always bought wine that way. That's how their mum and dad bought wine, right? There's not because they particularly love the experience. It's not because they get great service. It's not because it helps them discover new products they enjoy. It's just familiar. And I think, reappraising or questioning some of those purchasing habits is just going to lead to the acceleration of the move online. I think that'll be favorable for a number of different online models, obviously including our own.
If you think, like, your model seems to be well positioned for an inflationary setup, but are there any elements or certain parts of your business where you think, okay, maybe we should reconfigure this to stand better in an inflationary setup? Last time we talked about the glass bottles and their weight, which is a heavy factor by shipping and also in production. Maybe this is an example.
Yeah, actually, one area that we've been looking really actively at, which is both the way of mitigating inflation, but also a way of driving our group sustainability agenda, is the ways we can reduce the carbon footprint of our supply chain. And in particular, you highlighted glass. Our benchmarking shows that the life cycle emissions associated with glass production are one of the biggest sources of emissions in the wine business. So our UK MD, James Crawford, actually was interviewed recently and was talking through the steps that we've taken to lightweight a number of our molds in the UK market. And we've also taken some similar actions in the US and been able to make some really material progress. And I think also it's an opportunity of showing what you can do under the direct model to take customers with you on the journey. So, for example, we have a sustainability group in the UK. Luke is our sustainability lead, and he chats directly to customers and gets their feedback. And what we see time and time again is that actually when you talk to growers and winemakers, they're incredibly receptive to the sustainability agenda. The thing that is holding it back in the industry, I think, are the perceptions of traditional brand owners and big corporations. And, they're the ones that are driving, the choices for kind of glass molds that are, a workout in and of themselves. If you go and pick up a bottle of Napa Cab on the shelf, you don't need to go to the gym again that day. But when you have a model like ours, which lets consumers talk directly to winemakers, actually it's a lot easier to progress a conversation and make rapid progress in areas like that. So that's, I think, one good example where ultimately kind of good sustainability often tends to be good business. And we'll be looking at more areas like that if there are chances to strip out costs that ultimately doesn't add anything to the end product, doesn't add anything to the taste and the experience for the customer. Then I think that's a great area to focus on.
So there's also a certain education happening through the Naked platform about sustainability impacts.
Exactly, because I think, it's a microcosm for what we're looking to do every day and how we communicate to customers. Right? We want to help customers understand and recognize that, a lot of the ceremony, the cost built into the wine industry is sometimes an elaborate game of smoke and mirrors to distract and to encourage and to support, some inefficient business models and some high prices. And we want customers to recognize that if they go direct to high quality, talented producers making stuff they're passionate about, you can enjoy great wine and it can be affordable at the same time. And, the glass bottle is just an illustration of that, right? When you think about it, obviously you don't need a really heavy bottle to make a great bottle of wine. But a lot of times, because consumers don't feel that confident, we default to things that are kind of simple rules of thumb to help us, right? That's why people talk about, never order the second cheapest wine on the wine list, or, go for something with a label that looks like this, or a reassuringly heavy bottle. Or my favorite one, you ask people, what type of wine do you like? Say, I normally drink a $20, $30 bottle of wine. Well, if you think about it, that doesn't mean anything, right? But our job as a business is to help arm consumers with some of the information, the confidence to go and then start making some better buying decisions. And, when you get people questioning kind of, well, why does something cost that? And hang on, actually, then they can do the last part of the work for them. And, they work out very quickly that actually there is a better way of doing that. And, that's the model that we've got.
Maybe let us now jump a bit more to the customer side again and talk a bit about if you have a new customer who is first entering the Naked universe, you have to do some education work, but you also have to offer a great experience. Compared to 1 year ago or maybe 2 years ago, how have you gotten better in this offering of a great experience? What have you improved?
I think there are a few different things that go into that experience, right? And so the first area I think the area that we have consistently improved year over year over year in the time I've been in the business is the breadth and quality of the range has never been stronger. So, across those 225 winemakers we're working with, people making outstanding wines, everywhere from the Western Cape in South Africa to the Barossa Valley in Australia, back through the Russian River in California, and even some great sparkling wine from the hills of Kent in England. So the quality of that range, I think, has never been better. And that means, customers are getting access to great diversity of wine styles, an amazing product first up. And I think we are, starting now to work through some of the things we've been testing for a while to get a little bit more variety into those first cases as well, to let customers give us some information about what they enjoy and start to tailor that back to them. So I think that's an area that we are doing well. We can continue to do better, right? I think we can, continue to make that first case more and more relevant. But I'm very excited and passionate about that. I think the second, part of the experience, right? You want to have a simple, effortless shopping experience with nothing going wrong, and you want to meet expectations is really important, right? In the first part of the experience. We've done a really good job consistently at shortening the amount of time it takes us to get product to consumer, in particular in the US, where our model operating 4 different fulfillment centers across the country gives us a big speed to customer advantage in lots of areas versus some of our competitors. I think it's worth acknowledging, kind of in the UK, probably at Christmas this year, we didn't do as well as we'd have liked in terms of getting the basics of getting product to you on time, in line with your expectations. We didn't deliver that as well as we would have hoped. We could make excuses. Ended up the volume of orders we saw was in excess of what we anticipated. But ultimately they're just excuses, right? And we need to make sure we deliver on those basics of service. And that's a big focus for us at the moment, right? Making sure that we have the redundancy and resiliency in our supply chain and fulfillment operations, especially at a time when the labor market is tight, right? It's harder to get and make sure you've got continuity of labor and kind of hourly paid occupations, to make sure that even when something goes wrong, it doesn't affect the end customer experience.
How's WineGenie doing in this experience? Are there any metrics you can share with us?
There are a couple of things that we can share. So I think the most exciting thing for us is that we now have WineGenie consumers who've been on the service for over a year. And for those of you who are new to Naked, WineGenie is our platform powered by our proprietary data recommendations, which suggests you wines that you're going to love. You're in control. You pick the cadence of shipment, the price point, the split between red, white, different styles of wine. And having taken customers now through the course of a year on that, what we see is that actually there's very good feedback and rating. I think we have something like a kind of 90% rating when we do the user research. How did you find the product to use? And up from when we first launched into market, I think we were getting sort of a 7 out of 10 score. So ease of use has been enhanced a lot. We've given a lot more opportunity to customize and skip orders and tailor things to your personal choices. We've seen that customers stay on WineGenie, and that contributes to incremental revenue. So it's working for customers and it's working for Naked. The contribution economics of WineGenie makes sense. We've also seen that it appears to be especially relevant or of interest to customers earlier on in their life cycle. And actually seeing if we can really step change the rate of adoption is one of the hypotheses that team that's going to be working on helping customers navigate from their first case to their second case is going to look at. Because our adoption data to date suggests that it's of most interest when you're trying to get to know Naked, you want to discover new products, and a little bit more uptake from younger consumers.
Naked is often compared to the Netflix of wine, and there was also this quite interesting video on I think it was CNBC, where it was presented like this. How is your niche selection strategy going, and what are you building there over time?
Yeah, I think this is one of the things that, probably like developing great shows and content, it takes time. So we have been working very hard for, probably 18 months now to build out the diversity of wine styles on the platform. And I think I've told you this before, Tillman, there's kind of 2 different strands which have got, different level of emphasis or importance depending on which market we're talking about, between our 2 big markets. So in the US, there's been a real focus on building out our luxury range. So we describe that as wines over a $25 price point. And then a secondary focus is giving us breadth and of range and experience in, if you like, the kind of classic old world wine regions, more wines from Spain, Italy, France. If I move to the UK, I'd flip that emphasis slightly, where I think there's a big opportunity for us to add breadth to the range through different styles of wine and that older world profile, which is a little bit less about big, bold, primary ripe fruit. And, you get a little bit more of the kind of earthy characteristics, a little bit more tannin, a little bit more acidity in the wines. And then there's the secondary opportunity from a UK perspective is stretching the price architecture and adding some of those trade-up options. The way we like to work, is to find producers that we think we can work with over a long period of time and build a relationship between them and our customers. And that means we don't approach this in a kind of retail mentality. So it's not a case of going to a wine fair, kind of picking some products off the shelf and just filling the gaps. So it has taken some time. But I think to give you one illustration of that starting to have impact, if I looked at the sales through our kind of holiday quarter in the US, I think we had sales of wine by volume over $25 a bottle were up about 200%. So as we now start to see the benefit of decisions we made and wines we produced out of the 2019 vintage coming through into our range, that's translating through into great consumer uptake, and we feel very good about that. I think it's something that you'll continue to see kind of progressively roll out and see more of in terms of the customer experience over the course of the next year. And I think it should be one of the initiatives we hope will drive, kind of classic e-commerce world, revenue per member per month. I think where you see it through our disclosures, we think that's an initiative that's going to help support our sales retention.
Thinking about working capital, if we are on this thought concept, if you have the higher quality wines, they might need more time in the barrels. So you have more capital bound if you're selling more high quality wines, or is the turnover as fast as the non-premium space?
No, your dynamic is correct, right? So even if you might have a really quick sell-through, so even if your stock turn on finished case goods might be the same, you've got a longer production cycle, right? So you are deploying some of your capital to produce that product further in advance of the sale than you are on, a quick turnover. I think your most extremes in the world would be, imagine, a kind of early season rosé or something that, might be, being pressed in September, October, and you could be selling it in February. That's why wineries love rosé. It's great for the cash flow. Versus, a barrel-aged Napa Cab that we might release 3 years after vintage. They do clearly have different characteristics. I think the way we have thought about that is, making sure that in our pricing approach, as we've started to sell more of these wines, we've had to re-examine how we think about pricing product and make sure that we are accounting for the cost of capital when we think about the appropriate price to set. Ultimately, the time value of money is a real cost to the business, even if it doesn't, show up classically on the cost of goods. And so that's been an important step for us as we started to develop that luxury wine strategy. We said, okay, we need to have a pricing strategy that's consistent and recognizes that, so that we don't, so that the overall, shape of our P&L and balance sheet continues to make sense, and so that it is, genuinely accretive to see customers trade up into those products.
So there we will have a shift in the way you manage inventory, but there was also a shift in the way you manage inventory to serve new customers, and that you have more quality wines on hand to make a great experience. Do you think the second shift for the new customers will get back to the level it was in 2019, or do you think it will hold a more structural buffer to be able to have a great experience?
So sorry, I just checking on the. You gave me 2009, which I don't think you meant
19. Sorry.
I was thinking, I'm sure we can definitely recruit more customers than we did in 2009. So I think it's probably back to the first question you asked me to be boring and give you the same answer again, Tillman, on how do we think about growth. Ultimately, I don't think it's very helpful or very actionable to kind of think about, hey, this is a year where we will recruit X 100,000 new members or 1 million new, or whatever it might be. Because that gets you very much into a set of decision making and cascades all the way down through your operation, where people are very focused on volume. And when you get very focused on volume, you find people are losing sight of ultimately the metrics that we know and understand compound to create real intrinsic value over time. So we, in terms of the operational metrics we live and breathe in the business, we try to have people very focused, all the way through, for example, our growth marketing teams on, what's the rate of return, that ratio we talk about, our payback ratio between lifetime value and cost of acquisition. And then how much can we deploy in different marketing initiatives subject to a minimum threshold on that ratio. And so to be boring, that's how we operate the business. And, ultimately you work as hard as you can to try and maximize that. you deploy strategic initiatives like the ones I've talked about in terms of optimizing conversion rate, trying to improve that conversion from first case to second case. And when you have success there, you structurally improve your economics, and it means you can go back and flow through the calculation again. And actually, the cost of acquisition that's consistent with a payback ratio you're targeting goes up. And that makes it easier for you to deploy more capital. But we try and avoid solving to, here's a set number or here's a set kind of top line growth rate, because in our experience, whenever we've seen parts of our business tend more towards that mindset, it looks good for a small period of time and then it doesn't look good.
You already explained a bit of the difference you having, or different strategies you having in different markets. Let me boil it down to a question coming back to marketing. Are you marketing differently in the US as in UK or Australia?
We believe it's really important to have, a core body of our marketing capability located in market. And yeah, absolutely, we'll be marketing differently. So what's common is, if you think about, maybe let's take another analogy, the chassis is common. So for all our markets, we've got a proposition which is about offering two different things to customers. Rational differentiation, because we have an efficient model that reduces winemakers' production costs and connects them directly to consumers, means they can enjoy a higher quality of wine at a lower cost. And we have this emotional differentiation because you can have personal connection to the winemaker. You can understand their motivation, their story, and you can hear it direct from them. And that's going to be common across all our markets, and means that, a lot of the kind of principles of our marketing will be consistent. But to give you a couple of ideas of then, where you have really important kind of local autonomy to make that relevant. In Australia, we wouldn't talk about having the world's best winemakers. We talk about having Australia and New Zealand's best winemakers. And our research shows us that there's an incredibly strong kind of buy local movement, which means that we place real emphasis on that. And the second thing that our research shows really consistently is, this idea of, giving a fair deal is really important in Australia and resonates really well. So a lot of our marketing communication will emphasize, the way in which our model gives a fair deal to the little guy, a fair deal to small growers, small producers, and gives them and contrast that to the type of deal they're offered by the duopoly, Coles and Woolies, who own most of the liquor business out in Australia. That would be different from the narrative that we would operate in the UK. It would be different, again, if I go to the US, where actually with the structure of the market and the three-tier system, the focus becomes, more on helping customers understand just actually how wine gets from vineyard to their door, and helping them understand that they're the third person to buy that bottle of wine. And there's been, a big slug taken out of it by the distributor and the retailer along the way. So if they can go direct to the producer, they can access greater value. So common set of principles, but the way that's brought to life, and then all the way down to, the tone of voice and language, that's something that we own and bespoke in market.
We have like 4 or 5 minutes left, so maybe we can do 3 quick questions if you have a quick answer for them. I've heard there might be rumors about a political change in the tiered distribution system in the US. Is there anything to worry about?
Look, I mean, I'm not going to make any kind of promises or proclamations about kind of, what the legal or regulatory landscape in the US would look like. I can say that I think the core of the three-tier system, is very well established, is very well supported, not least by $400 million a year of campaign contributions made by distributors. When you look to the last set of data. So as far as I can tell, the areas that are getting the most focus are around challenges from retailers and retailers lobbying to gain access to cross-border direct shipping. And that's a status at the moment that is ambiguous. Some states would allow it. So in California, where I live, for example, I could order wine from a wine shop in New York and have it shipped to me. But in lots of states, for example, New York, I couldn't order wine from a wine shop in California and have it shipped to me. So retailers have different market access rights to producers like Naked. I think, as far as I can tell, that's the area that is getting the most scrutiny. and the area that's most likely to see more court cases decided. And that's something that's not around challenging the three-tier system. It's around ultimately adjudicating the rules on the edge of how it works. And, our business competes with retailers shipping in California just fine. So, the big debates that I see, not something that cause me undue concern. So that's probably the big trend I'm seeing in terms of regulation, unless there's anything else on your mind, Tillman.
For the south of you, there are two big tech companies, Apple and Facebook, and they have some struggles about identifiers and stuff like this, and this also impacted your business. When do you think this impact will normalize and it's easier for you to have the same efficiency in marketing on these platforms again?
I think there are a couple of different things in terms of normalization. One is ultimately that advertisers like ourselves, and I talk to lots of peers, chief marketing officers. There's a lot of consistency in terms of what I hear back in those conversations. One of the consequences, I think, and you see it in Facebook's latest set of results, is that advertisers are pulling back some spend, and that has a degree, like in any two-sided marketplace, of some self-correction. And, you see a period where, CPM rates were inflating a lot through most of 2021. And, that seems to be cooling off and coming a little bit back down. So, that's one way in which I think the ecosystem kind of finds a little degree of natural balance. I think for us then, I'm not focused on speculating as to, when things outside of our control are going to change. We're focused on really looking at what can we do and own to improve the way we communicate our message, to improve the cadence at which we're testing different types of creative and content, and therefore make sure that we are, being efficient in the channel, recruiting good volume of customers, but more importantly, getting the right customers in with the right messages that they really understand why Naked's different and why Naked's special. And we're generating a benefit beyond just acquiring some customers into a deal, but we're helping to get out the message that I'm very passionate about a better way for people to buy wine. So that's what we're focused on. I think we're seeing some traction, but there's still more work to do.
Imagine a world where Naked Wines would be listed in the US as their primary listing. When do you think such a world could become real? Or could such a world become real?
It's obviously an opportunity that that could become real at some point in the future. But I think for our job ultimately as a management team is to first and foremost focus on the opportunity we've got to grow and scale the business, right? And I wake up every day thinking, what are the things we can do to drive intrinsic value growth for Naked? What are the places we can invest, profitably at good rates of return that mean, under any set of circumstances, with any set of kind of valuation metrics or, investor sentiment, we've built something of real meaningful value. Then there's a second set of questions, right, which are like, okay, well, what is the right place for that business to operate? How's the right place for it to meet the right investors and be fairly valued? But I do think, there's secondary considerations beyond, making the business in and of itself, high quality and high value. The reasons you can imagine that world, there are all the obvious reasons why behind the question, right? We have seen a migration of the investor base towards US focused investors. And typically, although no one seems that focused on growth online stocks with a degree of risk in them right now, but typically that's a type of story that's resonated more with more investors here in the US. And obviously our market opportunity with a $25 billion TAM in the US is our largest one. And so if we operate successfully over time, increasingly, the revenue base of the business will move towards the US. So absolutely, it's something that you could imagine in the future, but I can't give you any breaking news, Tillman, I'm afraid, for your headline of the interview.
What a pity. But it was a pleasure to talk to you again. It was fun. Thanks for taking the time. And thank you for the audience for staying this hour with us. Thank you.
No worries. My pleasure. Thank you very much for having me.
Bye-bye. As in every video, also here is the disclaimer. You can find the link to the disclaimer below in the show notes. The disclaimer says, always do your own work. What we're doing here is no recommendation and no advice. So please always do your own work. Thank you very much.